Investing Basics. How do ETFs work? Exchange-traded funds, ETFs, enable you to invest in a stock market, investment theme or asset class, by investing in just one cost-effective and easily traded product. ETFs operate like mutual funds, with the big difference that they are listed on the stock market, so you can trade ETFs whenever you like during normal market hours just like other share. Because ETFs are index-tracking funds, there are no expensive fund managers or analysts to pay for, which makes them much cheaper to run and own than managed funds. Ironically, over the medium term, index-tracking funds beat most actively managed funds anyway. With just a single ETF, an investor can track the performance of a stock market index of hundreds or even thousands of listed companies. They can do the same with government and corporate bonds and commodities and currencies. There are two kinds of ETF. Physical ETFs track an index by buying the underlying assets with the same weight as in the index, to mirror its rise and fall. Synthetic, or swap-based, where the ETF provider enters a contract with an investment bank to provide the return of a particular index in exchange for a fee. In a physical ETF, the provider purchases all or a selection of relevant securities from the index to be tracked. A FTSE 100 index tracker holds all of the companies in the index in proportion to their weighting. If HSBC Bank was 7% of the index, the ETF provider would put 7% of its fund's assets into HSBC shares. As the value of these holdings fluctuate, they track the index's performance. An ETF's holdings and an index's constituents may not match precisely. A provider may hold a sample of the index it believes can replicate its performance, but at a lower total cost. This is especially used for large indices with hundreds or thousands of stocks, such as the MSCI World. A synthetic ETF does not directly invest in the index's constituents. Instead, an investment bank promises to pay the provider the daily return of the index, plus dividends, in return for a fee. Synthetic ETFs are useful for accurately tracking less liquid markets. ETF providers work with specialist firms known as authorized participants to ensure that you can freely trade your ETFs during market hours. For more information, visit DIYinvestor.net.